385 on the 10-year, the 2-year at 394 or so. All of this after this morning's PPI data came in a little bit softer than expected, showing an increase of only a tenth on the headline, and the core was flat. Tomorrow, we get the data on consumer prices to see if this downdraft continues.
All righty, shares of New York Community Bank continuing their comeback from a sharp drop earlier this year. Today, the stock is higher. 6 months, it is down 25%, but today higher by 9% as 3 investors exchanged their preferred stock for common. Meantime, shares of Valley National Bank have lost a quarter of their value this year, but have bounced back from lows earlier this summer. So what's ahead for regional banks as the economy may slow and we expect to be heading into a lower interest rate environment? Let's bring in Valley Bank CEO Ira Robbins for one of his periodic visits. Ira, good as always to see you. The stock market seems not to be in love right now, but that's the stock market's problem, maybe more than it is yours. Walk me through the net interest income and margin numbers. Why don't I just begin by nerding out and letting you do that?
Yeah, it's a great way to start, right? And from a banking industry, it's obviously the driver of all of our revenue. At an organization like Valley, approximately 87% of our revenue comes from the net interest income. So really, it's effectively what we charge on our loans and then what we pay back to our depositors. And when we're in an inverted curve, we just saw the update before, we were at a 10 basis point negative spread. That's a real challenge for the banking industry. At Valley, we saw a significant decline in our net interest income and net interest margin throughout the inversion. But we've actually seen an inflection point for the last 2 quarters. The margins actually begun to move up and increase, which is a real positive for us. And I think not just for Valley, but for the entire industry.
And if interest rates go lower, as many people expect they will starting in September, or maybe already have, how much will that be helpful to you?
I think it's a huge tailwind for the entire industry, specifically for Valley. And when rates began to move, it wasn't just the inversion that created the pressure. We saw a lot of our depositors actually move money from non-interest-bearing accounts into interest-bearing accounts, as well as into the Treasury products. And when the short end finally does begin to come down, some of that pressure that we've seen where the depositors have moved into some of these interest-bearing accounts dissipates, and the margin then expands based on that as well.
Although, Ira, I'm one of those people who has moved funds to something more interest-bearing. I'm not going to move it back, right? I'll still take upper 4s or 3s. I'd probably even take 2s over 0. It's sort of like we all just woke up and said, all right, I'll shift things around. And I don't know if that's unwinding.
Yes, I don't think that's going to unwind to the massive degree, but it's the change and the shift that's going to slow down, right? Up until this last quarter, we really continue to see a lot of people moving from non-interest-bearing into some of these higher yielding accounts. That's really stabilized now, and that really has stopped. So just the fact that that's not moving anymore and creating downward pressure on the margin is a big tailwind just in itself.
Tell us a little bit about where you are growing your loan business and where your loan business may be contracting.
Well, we're not growing commercial real estate. That's probably evident from an industry perspective. But we see strong growth in the C&I. We've been focused on building our C&I business at Valley for many years now. We've seen a compounded annual growth of over 10% the last 2 to 3 years just in the C&I business. And this last quarter, we grew 16% in the C&I business. So our belief is that some of the CRE portfolio really begins to contract. It's going to be offset by some of the C&I growth that we've seen.
C&I meaning what? Commercial and industrial?
Exactly. Okay. Business bank.
And which of those two is growing faster, the C or the I?
The C is really growing a bit more for us, which is a positive. And I think they come with deposits as well. So from a relationship perspective, it's a more valued asset. That said, historically, C&I does have a higher loss rate than what commercial real estate is. Mm-hmm. And I think that goes back to maybe some of the unknowns when we think about the commercial real estate. There's this perspective out there that every single commercial real estate loan is exactly the same and performs equally across geography, across asset class. And we've known from being in the business for almost 100 years that that's not the case. Office loans are obviously performing poorly today, but you look at other asset classes, whether it be industrial, warehouse, retail, and those are still doing really, really well. We look at different geographies. We look at rent stabilized in New York City, and that's a real challenge. But you look at multifamily in many other geographies, and they're really doing well. So we really need to not look at the asset class in totality and say everything performs the exact same, and really break it down into the individual buckets.